glass water, glass, नहीं, glass का glass.
Sir, it's live. You can start, sir.
Okay, okay. Hello, students. Myself, CA Amit Samriya. Good afternoon, all of you. And we are starting the second lecture of your corporate and management accounting. It's a crash course. In the last lecture, we studied about the entire syllabus and the theoretical concepts of each and every topic. Now in today's lecture, first of all, we will start with one of the topic, that is cash flow statement. Cash flow statement. First of all, we will discuss the concept of cash flow statement, and then we will understand how to solve the practical questions of cash flow statement. As per Accounting Standard 3, issued by Institute of Chartered Accountants of India, cash flow statement is prepared in a proper format. That is, format of cash flow statement is prescribed by AS3. Students, you very well know that cash flow statement is a part of financial statements along with P&L and balance sheet. Every company should prepare its cash flow statement. Every company should compulsorily follow the accounting standards. So accounting standards are mandatorily applicable on companies. Accordingly, we have to follow AS7, AS3 revised, AS3 cash flow statement. AS3 deals with presentation of cash flow statement. Now, there are two methods of preparation of cash flow statement. There are two methods prescribed under paragraph 18A of AS3 revised and under paragraph 18B of AS3 revised. There are two methods of preparation of cash flow statement. One is direct method and other is indirect method. So in today's topic, first of all, we will understand how cash flow statement is prepared. How cash flow statement is prepared. First, remember one thing. In your earlier classes, in your 11th class, 12th standard, or in your foundation standard, till you prepare cash book, cash account, cash in bank account, double column cash book, triple column cash book, in which you write receipt on the debit side and payment on the credit side of cash book. So first of all, in a very, very, very general sense, you should keep in mind that cash flow statement is nothing else. It is just similar to your cash account, cash and bank account, cash book, receipt and payment account, which you already prepare in your earlier previous classes. So first of all, basic meaning should be clear and general meaning should be clear. And what is cash flow statement in generality? In generality, it is only cash book, cash account, receipt and payment account. But the difference is, what is the basic difference? What is the major difference? between in cash, because you think that since cash book is already maintained, cash account is already maintained in the ledger, then what is the need of preparing cash flow statement? If it is similar to cash book, if it is similar to cash account, then what is the need of preparing again cash flow statement as a part of financial statement? What is the need? So student, the basic difference is that cash book or cash account, etc., cash and bank account, receipt and payment account, all are prepared in a chronological order, that is date wise. Date wise. In every transaction in financial accounting, in journal or ledger, we record the transactions date wise in a chronological order. In a chronological order. But cash flow statement is similar to cash account, bank account, but it is not prepared in a chronological order. It is not prepared date wise. So how it is prepared? The question arises, how it is prepared? Students, it is prepared activity wise. The first thing you should note that it is prepared activity wise. Cash flow statement is prepared activity wise. And what are the activities in the business? There are two types of activities in any business: ordinary activities and extraordinary activities. Ordinary activities and extraordinary activities. And what are extraordinary activities? Now you think, so the activities which are not ordinary are called extraordinary activities. It is an exceptional residuary definition. The activities which are not ordinary in nature are extraordinary. What it means? It means that what is to be done in the business, if what is to be done anywhere, it is ordinary, and what is not to be done, what is not to be happen, it is extraordinary. For example, if you are in a classroom and you are studying, you are doing your studies in classroom, it's an ordinary activity. But in classroom, if you are talking about movies or sports, it is extraordinary. Similarly, if you are watching movie in a theater and you are watching it, it's an ordinary activity. But in theater, you open the books and started reading your executive course subjects, then it is extraordinary. So the activities which are not ordinary is extraordinary. So what are extraordinary activities in the business? Loss by fire, loss by theft, insurance claim received, all are extraordinary activities which certainly not to be happened, but it happens. Which is certainly not to be happened, but it happens. It's an extraordinary activity. And the activities which are not extraordinary activities are ordinary activities. Now, what are ordinary activities? There are two types of ordinary activities in the business. In any business, there are two types of ordinary activities: operating activities and non-operating activities. Both operating and non-operating activities are ordinary activities in business. Now, what is non-operating? What is operating? Operating activities are day-to-day activities. Say goods purchased, goods sold, purchase return, sales return, salary paid, expenses paid, income generated. Yes, asset. Day-to-day activities. But if fixed asset is acquired, it is not a day-to-day activities. Equity share capital issued, it is not a day-to-day activity. Preference share capital issued, it is not a day-to-day activity. Preference share redemption, debenture issue, it's not day-to-day activity. The activities which are day-to-day activities are called ordinary activities, and the ordinary operating activities, and the activities which are ordinary but which are not day-to-day, which are not operating, are called non-operating activities. And non-operating activities are of two types. Non-operating activities are of two types, that is investing activities and financing activities. Investing activities and financing activities. Now, what is investing? What is financing? If the funds available in the business are invested in the business or outside in any other business, it is any item related to that is called investing activities. For example, we have funds of rupees 1 lakh and we invested in machinery, building, plant, furniture, etc. It's an investing activity. It's an investing activity. If X Limited is a company and it's invested in the shares of the another company, and the money is given to the Y Limited, another company, so money will be used by another entity. So it is investing activity for X Limited. So if funds in the business are utilized in the business or used in the business or in any other's business, it is called investing activity. And any item related to that is an item of investing activity. For example, shares are acquired by a company of another company worth rupees 20 lakh. So this 20 lakh is an investing activity and it is an asset for the company. And when dividend will be received or investments were in debentures, then interest will be received, then it is an income from investing activities. So you should carefully identify investing activities is a non-operating activities. It is not a day-to-day activities. And what are investing activities? Investing activity means the funds, any item which relates to the funds of a business utilized in the business or not in day-to-day activity. If it is utilized in day-to-day activities, it's an operating activity. Utilized in the business or in the business of any other person, it's an investing activity. And any other funds is brought into our business, it's a financing activity. Any item related to that is a financing activity. If a company needs funds, it issues share capital, money of public brought into the company, and that is why for company it's a financing activity. It's not a day-to-day activity, but it is not a day-to-day activity, and the money of others brought into the business, our business, that is financing activity. So students, keep in mind that there are two activities in any business, there is ordinary and extraordinary. The activities which are not ordinary are called extraordinary activities, and the ordinary activities are again of two types, that is operating activities and non-operating activities. Operating activities and non-operating activities, and non-operating activities are again two types, that is investing activities and financing activities. So basically ordinary activities are of two types or of three types of ordinary activities: operating, investing and financing. And investing and financing activity both combinedly called non-operating. So there are two ordinary activities, operating and non-operating. Operating plus non-operating is ordinary, and which is not ordinary, it is called extraordinary. So student, you should keep in mind that as per accounting standard 3, cash flow statement is prepared by two methods, direct method and indirect method. Whether it is prepared from direct method or whether it is prepared from indirect method, you should keep in mind that both the cash flows will be prepared activity wise. If the cash is coming into the business, cash comes into the business, yes, it is inflow. And when cash goes out, it is called outflow. And the term uses not only cash. AS3 use the term cash and cash equivalent. Cash and cash equivalent. Cash in bank account, bank balance is also similar to and close to cash. That is why it is called cash equivalent. Even short-term securities are cash equivalent. Short-term securities are those securities which are readily realizable into cash, which is readily realizable. So it is treated as cash equivalent. So student, keep in mind that cash account balance is a cash term, bank balance is a cash equivalent, short-term securities are also cash equivalent. So whether cash flow statement is prepared by direct method, we will definitely learn in today's class how direct method cash flow is prepared, how indirect method cash flow is prepared. But first of all, keep in mind that whether cash flow is prepared by direct method or by indirect method, it will prepare activity wise. First of all, in any cash flow statement or cash flows, both inflows and outflows from operating activities will be presented. After that, inflows and outflows of investing activity will be presented, and after that, inflows and outflows of financing activity will be presented. It is not related to date wise transaction, it is prepared activity wise transaction. So cash inflows and outflows from operating activities, cash inflows and outflows from investing activities, cash inflows and outflows from financing activity. All inflows and outflows, we will get the net cash increase or decrease. Cash may be decrease or increase, net cash increase or decrease, net cash and cash equivalent increase or decrease from all the three combined. Suppose there is inflow from operating activity 10,000. Suppose there is outflow from investing activity 2,000, and suppose there is inflow from financing activity 5,000. So two inflow 10,000 plus 5,000, 15,000 minus one outflow 2,000. It is 13,000. It is net positive figure. So it is called net increase. If outflow is more than inflow, it is called net decrease. So net decrease and increase in cash and cash equivalent is 13,000 in my example. Now we will write opening balance of the cash and cash equivalent, and definitely opening balance plus during the year changes, we will get the closing balance. So cash flow statement, whether prepared by direct method or indirect method, is consist of 5 points. The first is cash outflow and inflow from investing activity, operating activities, then cash inflows and outflows from investing activity, and then cash inflows and outflows from financing activities. Then the fourth point is the sum up of all the 3 points, that is net increase or decrease in cash and cash equivalent. And after that, cash and cash equivalent at the beginning of the year, that is opening balance, and we will arrive at the closing balance, cash and cash equivalent at the end of the year. So this is the basic presentation format prescribed by AS3 revised, issued by ICAI. Now, there are 2 methods, direct method and indirect method. The preparation of cash flow from direct method is very simple. It's very simple. Okay, so try to understand what I am telling. Number 1. Suppose cash received from debtors ₹1 lakh. First of all, you should be very clear regarding the identification of activity, how cash flow statement is prepared, how adjustments are done, what are the plus minus to be done in cash flow statement. That is altogether different aspect. First of all, you should clearly identify the nature of activity. So, nature of activity should be like this. Number 1. Cash received from debtors. Debtors are related to sales. Sales is a day-to-day activity. So it's an operating activity. So cash received from debtors is an operating activity, cash flow. And since cash received, it is inflow. Similarly, payment to creditors. Payment to creditors. Creditors are related to purchase. Purchase is a day-to-day activity, and payment is made to the creditors. So it's a operating activity, and there is an outflow of cash because payment is made to the creditors. Salary paid, wages paid, rent paid, any other expenses paid, which is of day-to-day nature. Salary, rent, postage, telegram, etc. Relate day-to-day are operating expenses, are operating results in operating cash flow. All operating expenses results in operating cash flow if paid. Wages paid, cash outflow from operating activity. Salary paid, cash outflow from operating activity. Rent paid, cash outflow from operating activity. So these are the basic examples of cash flows from operating activity. Similarly, equity share capital issued. It's non-operating activity. And the funds of public brought into our business. So it's a financing activity. And since cash is received, so it is inflow. So amount received by any company from share capital, equity share capital, preference share capital, from loan, from debentures, from bonds, etc. It's a financing activity transaction, and it is inflow from financing activity. And similarly, if equity shares are buyback, cash outflow, financing activity. Debentures are redeemed, preference shares are redeemed, loan repaid. Then this is the examples of cash outflow from financing activity. If company issues share capital, equity or preference, it has to pay equity dividend or preference dividend. So equity dividend and preference dividend is paid, it is an outflow, and since it is related to share capital, it's a financing activity outflow. If dividend is paid, equity dividend is paid, preference dividend is paid. Even interest paid on loan, interest paid on debenture, interest paid on any bonds, interest paid is an item of financing activity. Interest paid is an item of financing activity. So these are some examples of financing activity. Similarly, machinery acquired, building acquired, furniture acquired, shares of any other company acquired, debentures of any other company acquired, that is investment. These are all the outflows of investing activity. And similarly, earlier we discussed that interest paid is an outflow from financing activity. Accordingly, interest received is an inflow. from investing activity. If we invest in the shares of another company, we will receive dividend. Dividend paid outflow from financing activity, but dividend received is investing activity inflow. So it should be very clear that what are the inflows, what are the outflows, and those inflows or outflows from which activity. First of all, you should clearly note that you should identify the nature of activity. And the student, please listen this. What I am trying to tell is, for if we are preparing some cash flow statement for any bank or any NBFC or any financial institution, then interest paid or interest received is not financing or investing activity. It's day-to-day activity, and it's an operating activity. So for banking, yes, it depends on nature of business. What is day-to-day activities depends on nature of business. And if it is day-to-day activity, is operating activity, and if it is not day-to-day activity, it is financing or non-operating activity, maybe financing, maybe investing. But these are all ordinary activities, and the activities which are not ordinary activities are called extraordinary activities. So interest paid, generally a financing activity outflow. Interest received, generally a investing activity inflow. But for a banking company or a financial institution or NBFC, non-banking finance companies, etc., who are which is the main business of those companies are providing loans and taking deposits and paying interest and receiving interest. These are day-to-day operation for those companies, and that is why it's an operating cash inflow or outflow. It's an outflow inflow from operating activities. Yes. So students, now there are various other items. For example, tax paid. Tax paid. If it is a capital gain tax paid is arrives on sale of asset. So it's an investing activity. Furniture acquired, investing activity outflow. Furniture sold, it's an investing activity inflow, because your investment in furniture realized. If any machinery, building, fixed assets of any business acquired, it is an outflow from investing activity. But if it is sold, suppose machinery is sold, building is sold, then there is inflow, but inflow from investing activity, because selling of fixed assets is not a day-to-day activity. Assets are only sold when there is we are closing the business, that is going concern assumption is not hold good, and otherwise when the asset becomes scrap. So it is not a day-to-day activity. So cash inflows definitely. So when capital gain tax paid is there, so it's an outflow. Tax paid is an outflow from investing activity. And student, you know that any company, if declares dividend, it has to pay dividend distribution tax. Dividend distribution tax, which is also called corporate dividend tax, it is to be paid by the company. Dividend is received by the shareholder, but it is not dividend tax is not payable by shareholder. As per the Income Tax Act, dividend distribution tax is payable by company distributing the dividend. So it is outflow for the company. And since it is related to dividend distribution, and dividend distribution is on capital, so capital is a financing activity. Issue of capital is a financing activity. Redemption of capital is a financing activity. So dividend payable on it is a financing activity. So distribution tax on dividend is also an outflow from financing activity. So student, you should note that if there is a capital gain tax, it is an outflow from investing activity. If it is dividend distribution tax, it is outflow from financing activity. And if it is an ordinary income tax, yeah, it is a tax on day-to-day income. So it is an outflow from operating activities. So students, we are studying here cash flow statement, and now we will start preparing cash flow statement, how cash flow statement is prepared. Okay, now just see this. Cash flow statement by direct method, by indirect method. There are only two ways of preparing cash flow statement. It is by direct method and by indirect method. Preparation of this is as per AS3 revised. Preparation of cash flow statement is as per AS3 revised. Paragraph 18A of AS3 revised. Paragraph 18B of AS3 revised. Now, this consists of operating activities, investing activities, financing activities, then net, then opening balance, then closing balance. This is the general format. This is the general format of cash flows from direct method. Inflows and outflows from operating activities, inflows and outflows from investing activities, inflows and outflows from financing activities, and then net increase or decrease, and then opening balance, and we will arrive closing balance. Okay. Now, direct method cash flow. All the cash inflows and outflows of investing and financing activities will be written on second and third position. And the first position held by cash inflows and outflows from operating activities. Okay. Now, all the cash flows, inflows and outflows, other than tax paid, will be written first. Okay. Cash received from debtors, payment to creditors, cash received from bill receivable, payment made to bill receivable, wages paid, salary paid, any operating income received, any receipt or payment related to operating activities except tax paid, you will write in the first part. Okay. And you will get fund from operations. You will get FFO. This is called fund from operations. FFO is fund from operations. Now, after fund from operation will arrive tax paid deducted. Tax paid deducted. Tax paid will be deducted. Actually, we can deduct tax paid earlier also, but AS3 prescribed the format of preparing cash flow, so we should go through format. We should go as per the format, and cash flow statement is prepared as per the format, and accordingly, tax paid is deducted from fund from operation. What is fund from operation? All inflows and outflows from operating activities will generate fund from operation. And from that fund from operation, when tax paid is deducted, you will arrive at the answer, final answer. This is cash flow from operating activity. Cash flows from operating activities. Okay. Then investing activity inflow outflow, then financing activity inflow outflow. Then this is suppose A, this is B, this is C, this is D. Net increase or decrease of the three, then opening balance, then closing balance. So tax paid is deducted here. Now, students, one question arises in your mind. In cash flow statement, you write operating activity, investing activity, financing activity. All these three are ordinary activity. So where are the cash flows from ordinary activities? Where is the cash flow from extraordinary activities? In any business, there may be extraordinary activity, and extraordinary activity will also result in inflows and outflows. So that, because it's a cash flow statement, student, first you remember this. There is no place for non-cash item in cash flow statement. In cash flow statement, only cash items are recorded. Outstanding salary, outstanding rent, payment due to creditors, cash receivable from debtors, amount receivable from bills receivable, or amount payable to bills payable, which is receipt or paid. It's an item of cash. Receipt and payment is an item of cash. Only receipt and payment. No outstandings are, no non-cash items will be take place in cash flow statement. Non-cash items never comes in cash flow statement because it's a cash flow statement. So all items should be cash, and cash may be from ordinary, extraordinary, ordinary, in ordinary, operating, non-operating, in non-operating, investing or financing. Okay. So extraordinary activities, cash flow, this is operating activity cash flow, then investing. As per AS3, cash flows from extraordinary activities. Cash flows from extraordinary activities are shown at the end of operating activities. At the end of operating activities before starting investing activities. Cash flows from extraordinary items are shown after ordinary activities before starting investing activities. So this is the general format for cash flow statement from direct method. This is the general format for cash flow statement from direct method. Now students, we will understand indirect method of cash flow. Indirect method of cash flow. First of all, you should remember that there are two methods of preparation of cash flow. There are two methods of preparation of cash flow. One is direct, one is indirect. We discussed direct method. It's very easy to prepare cash flow from direct method if all cash inflows outflows are given. But now we're going to understand indirect method. First of all, make it clear that the only difference in direct and indirect method is in operating activity. There is no difference in financing activity, investing activity, opening balance, closing balance. Investing activity, financing activity, opening cash and cash equivalent balance, closing cash and cash equivalent balance are written in the same way, as it is written in direct method. There is no difference. You should write this, you should remember this, you should keep in mind this. There is no difference. Okay. Now, there is difference only in operating activity presentation. In direct method, in direct method, operating activities, cash inflows and outflows are written. But under indirect method, there is difference. And what is the difference? Difference is in presentation of operating activity. And that too is on only fund from operations. FFO calculation. Calculation FFO fund from operation will be calculated in a different manner. Under direct method, fund from operation is calculated directly. That is, all inflows and outflows from operating activities are written and we get fund from operation. But under indirect method, fund from calculation is calculated in a different manner. There is no change also in tax paid. Similarly, tax paid is minus. Under indirect method also, tax paid is minus, deducted. Similarly, same treatment. And yes, but and student, you should you can give this name. Suppose it's a cash from operation, finance. Since we write inflows and outflows, you can write directly cash from operation in direct method. You can directly write it. There is some little difference between fund from operation and cash from operation that we will discuss later. Accordingly, you can write here cash from operation directly because we already write all cash inflows and outflows. Indirect method, cash from operation. Now, so fund from operation, how to calculate fund from operation, and then tax paid. Tax paid. In between, there is some adjustment also. What are the adjustments? What are the adjustments? What are the adjustments? So first of all, see this. Under direct method, all cash inflows and outflows are written directly. You get the you will write that cash from operation. Yes, we can calculate cash from operation from fund from operation also, but under direct method you write cash from operations, and after tax deduct tax paid, and after getting tax paid you will get the cash flows from operating activities. But under indirect method, first of all fund from operation is calculated, then cash from operation is calculated, and then cash flow from operating activities is calculated. There is only difference in under direct method is presentation of cash flows from operating activities. Okay. Now, what is that difference? What is that difference? We will see the difference. Just a minute. Say this is profit and loss account. Profit and loss account consists of all income and all expense, whether it is operating, non-operating, whether it is cash, non-cash. Because profit and loss account results in net profit or net loss. And what is net profit and net loss of the business? Difference between all income and all expenses is net profit or net loss. So what is all income? In profit and loss account, there is gross profit, there is operating income. Operating income may be in cash, operating income may be non-cash, operating income may be in cash, may be in non-cash. Then now there is non-operating income in business. It may be in cash, non-operating income. It may be non-cash. Because profit and loss account is based on accrual system, it is not necessary that income is received. It may be receivable. So therefore, on the credit side of profit and loss account, there is gross profit. And there is operating income, cash operating income, non-cash operating income. There is non-operating income, that is non-operating cash income, non-operating non-cash income. And expenses are also operating expense, maybe in cash, operating expense, non-cash. Yes, depreciation. Example is depreciation. Is an operating expense. Depreciation, say there is asset of rupees 1 lakh. So 1 lakh is cash outflow from investing activity. And there is depreciation of 10,000. So depreciation is on day-to-day use. So it is an operating activity expenses. It is not an investing activity because we have not to further invest 10,000. Rupees 10,000 depreciation is a part of that is cost of asset. So 1 lakh asset acquired, it is an outflow from investing activity. And from its day-to-day use, there is depreciation. It is an expense. An operating activity expense, but it is a non-cash item. Then non-operating expense. Maybe in cash. Interest paid. Interest paid is financing. Paid is a cash item, but non-operating. And maybe non-operating item. Non-operating expense. Non-cash. Loss on sale of fixed asset. Loss on sale of furniture. Student, you should remember that. Profit on sale of fixed asset is always in cash. If rupees 100 is sold at 110, you will realize 10 rupees profit in cash also. But if rupees 10 100 asset sold in 90 rupees, there is a loss of rupees 10, and this is non-cash loss, because loss is there because only because you don't receive the. Then net profit before tax, you will deduct tax expense, you will get net profit after tax. And in net profit after tax, dividend, equity dividend, preference dividend, reserves, carried down balance. Now, student, try to understand the indirect method of cash flow. Try to understand the indirect method of cash flow. Indirect method of cash flow start from net profit before tax. Net profit before tax. And from net profit before tax, we will first determine fund from operation. And from fund from operation, we will determine cash from operation. And from cash from operation, we will deduct tax paid to get the cash flow from operating activities. Student, what is direct method? We directly write all cash inflows and outflows from operating activities. We arise cash from operation. Earlier I told fund from operation, but you keep in mind that in direct method it is cash from operation. Yes, there is some adjustment for making fund from operation to cash from operation that we will discuss, but right now it is not required. Under direct method, under direct method in operating activities, you write all cash inflows and outflows from operating activity. You will get cash from operations minus tax paid. You will get operating activity cash flow. Yeah, earlier I write fund from operation because from fund from operation we will also write cash from operation. But don't get confused. You write cash from operation. So under direct method, all cash inflows and outflows are written from operating activities. You will get cash from operation. Then deduct tax paid, not tax expense. It is possible that tax expense 1 lakh, paid 180,000 or 120. Payment is different from expense, may be different. There may be prepaid, there may be outstanding, but expense is 1 lakh. Expense of tax is 1 lakh. You can pay 80,000, outstanding 20,000. You can pay 120,000, prepaid 20,000. So tax paid, you should remember that cash flow statement is a statement of flow of cash. Only cash items will takes place in cash flow statement. So indirect method of cash flow deals with, you should start with NPBT. NPBT, net profit before tax, is the result of all items, whether operating, non-operating, cash, non-cash. All income, whether operating, non-operating, cash, non-cash, are added, and all expenses, whether operating, non-operating, cash and non-cash, are deducted. Okay, this is net profit before tax. So what we will do? So what we will do, that how net profit before tax will convert it into fund from operations. If we have to eliminate +2, we should do -2. If we have to eliminate -2, we should do +2. So this net profit before tax is the result of, this net profit before tax is the result of all income and expenses, operating, non-operating, cash, non-cash. So we will eliminate the effect of non-operating and non-cash. We will eliminate the effect of non-operating and non-cash. So what will remain? Operating cash, and it is required. If from a particular item which comes after operating, non-operating, cash, non-cash effect, and from that, if we will eliminate the effect of non-operating items and non-cash item, what will remain? Only operating cash. So all non-operating and non-cash expenses are added back. Non-operating expense, whether cash or non-cash, will be added back, because these two are deducted, then NPBT arrives. So again added back. Eliminating just always not means to deduct. If something is already deducted and we have to eliminate its effect, we should add back. If something is already added, and we should eliminate the effect, then we should deduct it. So all non-operating income are reduced from net profit before tax, because while arriving NPBT, these are added. So all we will start from net profit before tax, and all non-operating income, whether cash or non-cash, are deducted, and operating income which is in non-cash are also deducted, because we need operating cash only. The two requirements: we need operating cash, so there should be no non-operating, there should be no non-cash. So effect of operating non-cash, effect of operating non-cash, non-operating non-cash, non-operating cash. All non-operating items are added back, whether cash, non-cash. Operating items are added back only non-cash items, operating non-cash, and items reduced, deducted are non-operating incomes are always deducted, and operating income which is non-cash is deducted. So this plus this plus this plus this plus this minus 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 minus, you will get NPBT. Now again, NPBT plus 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 minus minus minus, you will get fund from operations. This is called fund from operations. Yes, directly you can calculate fund from operation from another formula: gross profit plus operating cash income minus operating cash expenses. Gross profit plus operating cash income minus operating cash expenses is fund from operation. Or net profit before tax plus non-operating non-cash, non-operating cash plus operating non-cash minus operating non-cash minus non-operating cash items minus non-operating non-cash items. This is fund from operations. And when fund from operation arrives, we will do adjustment of working capital. And after doing adjustment of working capital, cash from operation arrived. Cash from operation arrived. And from this, tax paid deducted. And final answer from operating activity. Here it is. Fund from operation, adjustment of working capital. You will get cash from operation minus tax paid. It is final answer, operating activity. And how fund from operation arrives? NPBT plus minus non-operating items plus minus operating non-cash items. Non-operating, all non-operating, whether cash or non-cash, should be added back or deducted. Added back if expense, deducted if income, and operating items are added back or deducted only if it is non-cash. Only if it is non-cash. And you will get fund from operation. Adjustment of working capital. then cash from operation, then tax paid, you will get the cash flow from operating activities. So students, it is very important to learn now how cash flow statement from operating activities prepared. Net profit before tax and before extraordinary items. If there is any extraordinary item in P&L, it should be also eliminated because its effect is shown on the end at the end of the operating activity. It should be added or deducted. If it is if there is inflow from extraordinary activity, it is added. If it is if there is outflow from ordinary activity, extraordinary activity, then it is deducted. So whenever there is preparation of cash flow statement from indirect method, you should start from net profit before tax and before extraordinary item, plus minus all non-operating expense income, all non-operating expense income, whether cash or non-cash. Non-operating will be eliminated entirely, and plus minus all operating expenses, only non-cash. Operating items, expense or income, only non-cash. So you will get operating cash, which is called fund from operation. Now, you will get given in the question that opening balance and closing balance of debtors, creditors, bill receivable, bill payable, stock, current asset and current liabilities. So difference of current asset and current liability is called working capital, and you should adjust that working capital from fund from operation. If debtors opening is 10,000 and closing is 12,000, there is increase in debtors 2,000. Remember that increase in current asset is an outflow. You should learn this. Increase in current assets, outflow, deducted from cash flow statement. Decrease in current asset, inflow, added in cash flow statement. Increase in current liability. Increase in current liability is an inflow. Just opposite of current assets is an inflow, added in cash flow statement. Decrease in current liability, say there are creditors of 10,000 opening and 7,000 closing. So difference is 3,000. So definitely creditors reduce. It means amount is paid. It's an outflow. So 3,000 is an outflow. Increase in current asset is an outflow. Decrease in current asset is an inflow. Increase in current liability is inflow. Decrease in current liability is outflow. You should adjust here. And student, you should remember that only those current asset and current liabilities are considered here which are related to operating activities. Outstanding interest. Interest paid is a financing activity outflow. Outstanding interest opening 2,000, closing 5,000. Difference not considered here because it's a financing activity item. So first of all, you will start indirect method from net profit before tax and extraordinary item. Then do adjustment for non-operating items, non-cash item, and operating non-cash items. Then you will get you will arrive at fund from operation, and from fund from operation, do working capital changes. You will get cash from operations. Under direct method also, there we can calculate fund from operation, then we will do working capital changes, then we will get cash from operation. Earlier I wrote fund from operation, but remember student, all inflows and outflows of the operating activities, if you directly return in the cash flow statement from direct method, you will directly get cash from operations. There are some questions in which under direct method we will calculate fund from operation. So it is somewhat confusing. That is why I changed, and I told you that in direct method you will get cash from operations, and if you will deduct tax paid, then it is cash from operating activity. But under indirect method, you will first get fund from operation, then do working capital changes, then you will arrive at cash from operation, then minus deduct tax paid outflow. Now it is cash from operating activities. So students, this is the preparation of cash flow statement. This is the preparation of cash flow statement. Recall this. Okay. So this is how cash flow statement is prepared from direct method and from indirect method. Just recall this, review this. Just try to make sure that you will get the concept. Now, students, the next topic is accounting for redemption of debentures. In last class, in first class of our crash course class, I briefly give you the some concept, basic concept regarding redemption of debentures. Okay. Now we are going to start accounting for redemption of debenture, and in that a very specific portion when debentures are purchased from the open market and then redeemed. So how accounting is done in that particular case? In that particular case, okay. Accounting for redemption of debenture. Accounting for redemption of debenture. Accounting for redemption of debenture. Okay. Yes. Suppose it's a balance sheet extract. Liabilities 8% debentures, say rupees 100. Rupees 100 debenture, rupees 7 lakh. Now company wants to redeem this debenture and purchasing from open market. Okay. So purchase of debentures from open market. Company is purchasing its debentures from open market. There are two cases in this. immediate cancellation, held as investment, and then cancelled. There are two types of problems involved. Company purchase its own debenture, purchase their debenture from open market, immediately cancelled, and second part is held as investment and then cancelled. Now, what is immediate cancellation? What is immediate cancellation? Company went to the open market and purchased this 7 lakh debentures at rupees 7,50,000. Company pay to the money to the investors and take back the debentures So what will be the accounting entry? 8% debentures account debit, liability decreases debit to bank 750. Company purchase its debenture from open market by paying extra money. This is called loss on cancellation. 50,000 loss debit, balancing figure. Why this is called loss on cancellation? This is called loss. This is loss because rupees 8 lakh liability, for rupees 8 lakh liability, company pays 8,50,000. Extra money is paid, so it is lost to the company. And by paying this liability is cancelled. So this is called loss on cancellation. It's just a name. If there is any loss, any name you will give to the loss, it will be debited. So 8% debenture account debit, loss on cancellation account debit to bank. Similarly, if suppose 6,90,000 was paid, then there is POC, profit on cancellation, on credit side of the entry, credit part of the entry. So remember this, whenever company purchase its debenture from open market, it is just similar to redemption. Because payment was done and the debentures are cancelled. In normal redemption also, payment is done and debentures are cancelled, liability is cancelled. In this case also, the only difference is that if there is a normal redemption, in that case, it was done on the due date. On the due date, company invites debenture holders and make the payment. But in this case, there is no invitation. In this case, there is no wait for due date. Any time before the due date, redemption date, any time, whenever company has sufficient funds and company wants to cancel its liability, company will go to the open market and buy its debentures and liability is cancelled. So this is called purchase of debentures from open market. This is called purchase of debenture from open market and immediately cancelled. Liability is immediately cancelled. And definitely, if liability is cancelled, then further company is not liable to pay any interest. Since date when debentures are outstanding, company is liable to pay debenture interest. But since the liability is cancelled on this date, on a particular date, now there is no interest liability on the company. So this is entry. So you should remember that, student, whenever any company purchases its debenture from open market and immediately cancel the liability, in that case, there may be profit, there may be loss, because amount paid is more or less than, if there is equal amount, same amount, then there is no profit loss. But amount paid is more or less than nominal value of debentures, and therefore there is profit or loss. Such profit or loss is called profit on cancellation or loss on cancellation, and such profit or loss on cancellation should be adjusted with capital reserve because it's the nature of capital profit or loss. Okay. Now, second thing, company went to the open market Company went to the open market and purchase its debenture, but not immediately cancelled. Such debentures are kept as an investment. Note this: if any company, say X Limited, buy shares of another company Y Limited, then for X Limited it is investment in shares of Y Limited is an asset. So similarly, if any company buys its own securities, it can be kept as investment. It can be kept as investment. So the second part is held as investment and then cancelled. Held as investment and then cancelled. Now, what is the accounting entry in this situation? Now, what is the accounting entry in this situation? Okay, so company went to the open market and buy debentures of rupees 7 lakh at rupees 7 lakh 50,000. Entry will be passed. Investment account debit to bank 7 lakh 50,000. If one company purchases the shares of another company, it is investment for the purchasing company. Similarly, if one company purchase its its own debentures, its own securities, then also it can be treated as investment for the company. So, investment to bank. These investments are also called own debentures. These investments are also called own debentures. Now, there is no need for different name. It's an investment. You can give any name to that. There is own debenture. Next. So what is the impact of this entry in financial statement? In financial statement, suppose after this transaction, the balance sheet is prepared. So on the liability side, there are 8% debentures of rupees 7 lakh. Liability. And against this liability, there is asset investment, which is called own debenture, 7 lakh 50,000. This amount may be any amount, maybe 740, maybe 750, maybe 7 lakh, maybe 690, maybe 680, maybe 640, because it's an investment. Assets are recorded at cost. Investments are initially recorded at cost. Yes. Investment to bank. So this is company went to open market, purchase its debentures from the open market, make payment to debenture holders, but these are liabilities not cancelled. Liability is still in the books and asset is created against it. Now what will happen? Say after 3 months, company cancel this liability as well as asset. Because company already paid the amount to the outsiders, now it is just a formality to the company to cancel this liability. If liability is directly cancelled, entry will be liability to bank. But if liability is not cancelled, first asset is recorded, to bank was already done. So now the entry will be, now at the time of cancellation, what will be the entry? It is 8% debentures account debit 7 lakh. To bank was already done. Here to bank directly. Here to bank is investment to bank. Now it is cancelled. Liability is cancelled against asset. So to investment account. Investment is 750. And now the liability is cancelled with asset. So the difference is loss on cancellation. Balancing figure 50. Entry is, I am writing here, 8% debenture account debit, 7 lakh. When it is cancelled to investment, your own debenture, 750. Loss on cancellation, balancing figure, 8% debenture account debit 7 lakh, loss on cancellation account debit 50,000, to investment account 7 lakh 50,000, to investment or to on debentures account 50,000. So whenever company purchase its debentures from the open market, it is similar to redemption because company has to pay for it, and debentures liability, and the payment is done to debenture holders. Now there are two options available with the company: purchase from open market. First is immediately cancellation. Second is held as investment, then cancelled after some time. If immediately cancelled, liability account is immediately debited and bank account is credited. Difference is profit or loss on cancellation is credited or debited to adjusted with capital reserve. But if it is held as investment, first entry is passed, investment account debit to bank by the cost of that investment, and then after some time, investment account is credited, liability is debited. Liability is debited means liability cancelled. Liability cancelled with investment. Difference is profit or loss on cancellation and adjusted with capital reserve. Now you have a doubt, you will ask that, you have some question regarding this. Sir, what is the interest? Suppose investments are purchased on 1st January. Investments are purchased on 1st January and cancelled on 31st March. So what about 3 months interest? Since the liability is not cancelled, suppose a company purchased its debenture on 1st January, held as investment, and payment is and liability is cancelled on 31st March. So the question arises, since liability is not immediately cancelled, debenture liability is cancelled after 3 months. So what will be the treatment of interest? Company has to pay the interest. So student, remember this. In this situation, when it is held as investment, we will see the company as an accountant. We will see the company from 2 points of view: company as a company and company as an investor. For company as a company, debenture is liability, and for company as an investor, own debentures are assets. So for company as a company, interest expense is an expense, and for company as an investor, interest is income. Since there is liability of 7 lakh debenture and the entire debentures are purchased from open market. So in this case, for example, 7 lakh, 8%, 7 lakh, 8% of 7 lakh is 56,000. 56,000. So we will pass 2 entries. Suppose company as a company will pay interest to bank, and company as an investor will receive bank to interest 56,000. Practically no bank credit, no bank debit, because company has to pay and company has to receive in this case. Suppose there are 7 lakh debenture, only 3 lakh 50,000, 50% is brought from the open market. Yes, then remaining 50% is with the public. So company has to pay the interest on it. Suppose out of 7 lakh debenture, only 5 lakh debentures are purchased from the open market. So on rupees 2 lakh debenture, company has to pay the interest to the outsider. But the amount of liability and the amount of asset, in this case, total 7 lakh rupees, there are debentures of rupees 7 lakh, and the entire 7 lakh debentures are purchased from the open market at rupees 7 lakh 50,000. So in this case, and interest is always calculated on nominal value. Whether you purchase debenture for 7 lakh 50,000, for 7 lakh 40,000, or 6 lakh 90,000, or 5 lakh, it doesn't matter. Interest is paid or payable only on nominal value, par value, which is 7 lakh. 8% of 7 lakh is 56,000. So company has to pay the interest of 56,000. For company as a company, 56,000 interest is expense, and for company as an investor, this 56,000 is income. We can pass 2 entries for understanding, but we can finally make 1 entry for this. Interest account debit to bank 56,000. Company as a company will pay interest to its debenture holder. There is no debenture holder. Company itself is a debenture holder. Company purchase its own security and held as an investment. So company as a company, there is liability for debenture towards debenture holders. And who is debenture holder? In this case, company itself is a debenture holder because company has purchased the debenture. So what will happen? Students try to understand that as a company will pay interest to bank 56,000. As an investor, company will receive the interest, bank account debit to interest. Practically no bank debit, no bank credit. So net entry is interest to interest. Debenture interest is an expense. And the interest which the company receives is interest on investment, interest on debenture. So you should remember that, students, debenture interest is always expense for the company. And interest on debenture, if received by the company, it is income for the company. So the net entry is, there is no effect of entry. There is income as well as expense. Net of is zero. But as per the full disclosure concept, as per the concept of full disclosure, we will make the entry. Debenture interest to bank, then bank account debit to interest on investment, interest on debenture. Then the net entry is debenture interest account debit to interest on debenture. Debenture interest expense will be debited to P&L, and interest on investment, interest on debenture will be treated as income and credited to P&L. So whenever company purchases its debenture from open market, there are two accounting treatment. That is, the liability is immediately cancelled, or it is first it is treated as asset and then cancelled after some time. In both the cases, any difference between the amounts values will be debited or credited to profit or loss and cancellation, which is a profit or loss in the nature of capital nature, and therefore it is adjusted with capital reserve. When the liability is immediately cancelled, liability to bank. But when it is held as investment, first investment to bank and then liability to investment. Investment has other name called own debenture. Own debenture means company's own debenture. It's an asset. And when there is own debenture, when the debentures are held as investment, company as a company will pay interest to company as an investor. So entry for interest, both the entry, income and expenses should be passed. Debenture interest is an expense for the company, and interest on debenture is here. It is income for the company. Okay. It should be very clear. Now, student, debenture interest is always expense. And interest on debenture means interest on investment is income. Okay. But interest on debenture is also an expense. How? Suppose company purchased this debenture from open market on say 1st January. 1st January. Company purchased this debenture from open market on 1st January, held as investment. And the interest dates are two dates, suppose 30th September and 31st March. Company pays 6 months interest 2 times in a year to its debenture holders. Now debenture holders on 1st January sell the debentures to the company. That is, company purchases debenture from the market on 1st January. So what will happen? Debenture holder from whom the company acquired the debentures will ask to the company that he has received interest till 30th September. October, November, December, 3 months, for the period of 3 months, debentures are held by those debenture holder. And no company buy it on 1st January, and then company will hold it for January, February, March, which is the next date of interest. So debenture holder asks for 3 month interest from the company. If you purchase 7 lakh debenture for 750, 690 or 680 or 780, any amount, that is different. But debenture holders, along with price of debentures, ask for interest for 3 months, October, November, December. Because in that 3 months, debentures are held by that debenture holder. Company has purchased that debenture on 1st January. Get my point? Suppose 3 month interest comes out to be 14,000. 14,000. Suppose. So when debentures are purchased, entry will be done investment to bank. When interest is paid, then entry is called interest on, not debenture interest. Debenture interest is an expense for the company related to liability of debentures. An interest on debenture is an expense while purchasing investment. When company will purchase his investment to bank 7,50,000, and along with this, company pay 14,000 interest on investment on debenture. That is called interest on debenture account debit to bank. Debenture interest to bank means company is paying interest to debenture holders for liability of debentures. And interest on debenture paid at the time of purchase means it is paid for purchasing the investment. Without giving that 3-month interest, company is not able to purchase its debentures, own debentures at 7,50,000. That is why. And definitely, students, company will pay 3-month interest. Then on 31st March, suppose the company is not purchased, I purchased on 1st January. So I will pay 3-month interest, then I will receive 6-month interest. Because due date interest is paid twice a year, 6 months. Company will not pay to each and every debenture holder for 1 day, 2 day interest, because you do your transaction in market. Company will pay interest only on due dates and only to that person who is holding that debenture. If I purchase debenture on 1st January from a particular debenture holder, then I will buy that debenture by paying 3-month interest. And then 31st March, I will get entire 6-month interest. So total I earn 6-month interest and pay 3-month interest. So 3-month interest is my income, that is for January, February, March. Because in that period, I hold the debentures. So similarly, company as an investor will pay 3-month interest at the time of payment, at the time of investment acquired. When company acquired rupees 7 lakh debentures, 7 lakh face value debenture at rupees 7,50,000 on 1st January from any debenture holder, company has to pay 3-month interest according to the dates. In this, I took the date 30 September. So October, November, December interest is to be paid by the company to the debenture holder. Now company holds this investment for 3 months. So what about this 3-month interest? Again, January, February, March. So this 3-month interest is interest expense for company as a company and interest income from company as an investor. So interest expense for company as a company is be debited and transferred to P&L, debit side, and company as for company as an investor, interest on own debenture is treated as income. So interest on own debenture is income, but if paid at the time of purchase, it is expense. Interest on own debenture when paid at the time of purchase is an expense, and interest on own debenture is an income when received. But debenture interest is always an interest expense for the company for its liability. So purchase of debenture from open market. Immediately cancel. Immediately cancelled. Debenture, liability, debit, bank, credit. Difference is profit or loss on cancellation. No further interest payable by company. Held as investment and then cancelled. Held as investment and then cancelled. Asset, investment account or own debenture account, debt. Bank, credit. Interest paid at the time of purchase of own debenture. So at the time of purchase of own debenture, when interest paid, interest on own debenture account, debit, bank, credit. Now company is divided into two parts. Company as a company as a investor. Company as a company, for company as a company, debenture interest is expense, and for company as an investor, interest on own debenture is income. And when own debenture cancelled, debenture liability account, debit, investment, own debenture account, credit. Difference is profit, loss on cancellation. Any profit or loss on cancellation, in both the cases, it's a capital profit or capital loss. It's a capital profit or capital loss adjusted with capital reserve. Adjusted with capital reserve. Note this properly. So you note this, students. Please note down this concept of purchasing of debentures from open market. Okay. Next. Yes, just after a few minutes, we will take a short break. Now, in last class, we discussed about underwriting concept. Now, how to calculate the liability of underwriters? Theoretically, already discussed it in our last class. Now, how underwriter's liability is calculated? Suppose there are two underwriters, Nancy and Joseph. Suppose there are two underwriters, Nancy and Joseph. Now, total issue, say gross liability, total issue is 1 lakh shares. Public issue is 1 lakh shares. Other than share issued to promoter, directors, etc., 1 lakh shares have to be issued to public. 1 lakh shares have to be issued to the public. Nancy and Joseph are the two underwriters. Underwrite this public issue in 3:2. So the gross liability for Nancy is 60,000 and for Joseph is 40,000. Now, there is firm underwriting. What is firm underwriting? Firm underwriting is initial commitment. Initial commitment, underwriters, irrespective of the shares sold by them, they agreed to buy the shares of the company. So firm underwriting, suppose by Nancy is 5,000 shares, by Joseph, it is 2,000 shares. Total 7,000. Now they are liable to sell only 93,000 shares. It means that firm underwriting is deducted. And Nancy is liable to sell 55,000 shares and 38,000 shares. Joseph is liable. So, a student, you should know that, you should keep in mind that whenever liability of underwriter is calculated in the topic of underwriting, then first of all, gross liability, from gross liability, if there is firm underwriting is deducted. That is, we will calculate the liability of underwriters excluding firm underwriting. Because firm underwriting means they are liable to take, they are compulsorily liable to take such shares which are firm underwritten. So we will deduct this from gross liability. Yes, this is liability. Underwriters will take these shares, but underwriter will take these shares, but we are first calculating liability of underwriters excluding firm underwriting. Next. Now there are marked applications. What is marked applications? Marked applications are those applications which are sold by the underwriters, which bears the stamp of underwriters. So Nancy sold, say, 35,000 shares. Joseph sold 28,000 shares. Total is 63,000 shares. Now the balance liability of Nancy is 20,000 shares, and for Joseph is 10,000 shares, and total is 30,000 shares. Because underwriting is an agreement or contract between the company and the persons called underwriters, and who committed to sell the shares on behalf of the company. And the main thing is that if such shares are not sold by them to the public, then they are liable for taking those shares. And that is why now after after deducting marked applications, Nancy is liable to buy 20,000 shares and Joseph is liable to buy 10,000 shares, excluding firm underwriting, because firm underwriting is deducted. Now, Nancy is liable for this, Joseph is liable for this, total 30,000 shares is liability. But suppose there are unmarked applications also. Say 5,000. What is unmarked application? What is unmarked application? Marked applications are those shares which are sold by the underwriters but unmarked applications are those shares which are not sold by the underwriter, which are not sold through the underwriters, which are sold by the company itself or bought or purchased by the investor at their own. There is no role of underwriter in it. So here company will compel Nancy to take 20,000 shares and Joseph to take 10,000 shares, total 30,000 shares. But how can company compel? Because company is not having 30,000 shares, because 5,000 shares are also sold. So the benefit of unmarked application is given to underwriters. No underwriters are liable only for 25,000 shares. So the benefit of unmarked application is also given to underwriter. And it is given in the ratio of their gross liability, that is 3,000 and 2,000. If some ratio is mentioned in the problem, then you can take that ratio, otherwise gross liability ratio. Now the Nancy is liable for 17,000 shares and Joseph is liable for 8,000 shares. This is called net liability of Nancy and Joseph. But this is the liability excluding firm underwriting. Excluding firm underwriting, Nancy has to buy 17 and Joseph has to buy 8. Then after that, if we calculate total liability, then again firm underwriting is added back, and it is 5,000 and it is 2,000. Total is 7,000. So 22,000 shares including firm underwriting, 10,000 shares including firm underwriting, and 32,000 shares including firm underwriting is the final liability. If there is no firm underwriting given in the problem, then net liability and final liability are same. But if firm underwriting is given in the problem, then first deduct the firm underwriting, then at the last add the firm underwriting. Before adding firm underwriting, you will get the net liability, and after adding the firm underwriting, you will get the final liability of underwriters. In the statement of this is the statement of liability of underwriters. So what is the format? Gross liability minus firm underwriting minus marked application minus unmarked applications. Net liability, add back firm underwriting, final liability. Sometimes firm underwriting is also deducted in the ratio. There is another method. So in that case, firm underwriting and unmarked applications have same treatment. And in this method, firm underwriting and marked application have same treatment. Okay. It is mentioned in the problem which method is to be used. So firm underwriting sometimes should be deducted by using a method, second method, that is in the ratio. Depends on the question, information given in the question. Yes. So this is the basic format. So student, this is the method to calculate the liability of underwriters. Gross liability minus firm underwriting. Why you deduct this? First, we are calculating liability excluding firm underwriting. Why? Because underwriters already agreed for this firm underwriting shares. They will take this irrespective how many shares are sold by them. This is the liability which arrives. This liability 17,000, 8,000. This is the liability which imposed on the underwriters because they does not sell the shares. They does not sell the total shares that is to be sold by them. Yes, they get the benefit of this 5,000 unmarked application. If there is no unmarked application, their liability is more. Since there is unmarked application, their liability reduced. So underwriters has two liability. One firm underwriting shares liability and another liability is this net liability. And the net liability plus to firm underwriting, you will get the total liability. And it's in a very simple manner. In a very simple manner. The shares which are not taken by the public, the shares which the securities, maybe debentures, the securities which are not taken by the public should be taken by the share underwriters. And public means marked and unmarked both. Public means marked and unmarked both. Whether it is marked application or whether it is unmarked application, it is taken over by the public. Whether it is through underwriter, yeah, without underwriter, it is taken over by the public. So marked and unmarked application both includes combinedly called public. So marked is 63, unmarked is 5. Marked is 63, unmarked is 5. So total is 68. Sorry. So total liability is 1 lakh shares. Public has taken 68,000 shares marked and unmarked. So now underwriters to take 32,000 shares. Total. Out of 32, 7 is for underwriting. So 25 is remaining underwriting. 25 plus 7, 32. Okay. So this is the method of calculating underwriter's liability. So students, till now we discussed in the today's class. In the first class of crash course, I told you that there are two parts of your corporate and management accounting: financial accounting, management accounting. We started corporate financial accounting. That is why in first class I brief you all the topics regarding the concept of those topics and theoretical and conceptual clarity of these topics. And in today's lecture till now, we have done our cash preparation and presentation of cash flow as per S3, then redemption of debenture through open market, immediate cancellation and endless investment, and how to calculate the liability of underwriters. Okay, now we will take a short break. Class will resume after 10 minutes. Okay, students, thank you very much. Meet you soon. Hello, my dear students. So here we are again with you peoples. Now I'm sharing screen. This is your study material of corporate and management accounting. So students, we have studied in the first class Introduction to Financial Accounting, concept of debit and credit. Now this we studied in the last lecture, equities and liabilities, presentation of balance sheet, format of balance sheet, formats of profit and loss account. How balance sheet is prepared, how profit and loss account is prepared, what are the components and contents of profit and loss statement. Now this is lesson 3. What is share capital? What is the accounting? How accounting for share capital is done? How accounting is done for shares issued for consideration other than cash? Accounting for redemption of debentures, underwriters liability. Accounting for issue of debentures, in the last class we discussed. Okay. Now students, we will discuss accounting standards in today's lecture. Accounting standard 1 is disclosure of accounting policies. So while preparing a financial statements, an auditor should follow the accounting standard and disclose all the accounting policies. And any impact of changes in accounting policies, any impact of accounting policies or change in accounting policies on financial statement should be disclosed. And while preparing the financial statement, financial accountant should consider going concern, consistency, and accrual, which are the basic fundamentals of accounting. Going concern, consistency, and accrual. And now there is a accounting standard 2, valuation of inventory. At the year end, inventory is asset for business. It is current asset for business. Inventory is also called stock. There are 3 types of inventory: raw material, work in progress, finished goods, and raw materials and consumables. Raw material, finished goods, work in progress, and consumables. As per accounting standard 2, at the end of each year, inventory is valued at cost or net realizable value, whichever is lower. How cost is calculated, how NRV is calculated, what are the various methods of calculating cost, what are the cost formulas, first in, first out, weighted average method. These are all prescribed in AS2 revised, inventory valuation. So inventory should be valued at cost or net realizable value, whichever is lower. The next thing is AS3, cash flow statement. Cash flow statement is as per AS3 revised. There are 2 methods, direct and indirect method. And in today's class itself, we discuss cash flow preparation and presentation of cash flow statement by direct method as well as by indirect method. Now, students, AS4 is regarding contingencies and event occurring after balance sheet date. At the as on balance sheet date, if there is any contingency, any uncertainty due to which there may be loss, there may be gain, there may be asset, there may be liability. But liability, contingent asset, and contingent gain is discussed in AS29. AS4 only covers contingent losses. So if at the balance sheet date, if there is any contingency as on balance sheet date, any uncertainty as on balance sheet date, and there is any loss, contingency loss is on balance sheet date, then as per AS4, provision should be made for such loss if it is probable. If it is not probable, chances of it is very low, then it should be disclosed only. Then the only disclosure is required, provision is not required. But and there the second part of AS4 is event occurring after balance sheet date. Event occurring after balance sheet date are those significant events, those events which occur after balance sheet date, but up to the date on which the financial statements are approved by the approving authority, say board of directors in the case of company. So suppose financial year ending date is 31st March and board approval is on 15th May. Any event occurring between these dates is called event occurring after balance sheet date. And as per accounting standard 4, any event occurring after balance sheet date, if there is event occurring after balance sheet date, it may be of 2 types, adjusting event and non-adjusting event. Say in this date, after 31st March and up to 15th May, there is loss by fire, bad debts, any loss arises, then it should be disclosed or adjusted. If it is adjusting event, it should be adjusted this year. Even if it is related to next year, it should be adjusted this year. And if it is non-adjusting event, then it should be disclosed this year and adjusted next year. AS4 is contingencies and event occurring after balance sheet. AS5 is all about preparation of profit or loss account, how profit and loss account is prepared. AS5, net profit or loss for the period, net profit or loss for the period, prior period item, extraordinary item, changes in accounting policy. It's a big name, net profit or loss for the period, prior period item, changes in accounting policy and estimates, and extraordinary items. So AS5 explains that how P&L is prepared, what are the content of P&L. I earlier told in the lecture of cash flow that P&L consists of income and expenses, maybe operating, maybe non-operating, maybe cash, maybe non-cash. Income may be cash, income may be non-cash, income may be operating, income may be non-operating, expense may be cash, expense may be non-cash, expense may be operating, expense may be non-operating. And all the items of income and expenses, whether operating or non-operating, cash or non-cash, will be in P&L, trading and P&L. Definitely. And this is all about AS5. AS5 also mentioned that if there is any change in accounting policy and due to which it impact the financial statement, profit and loss account, then such impact should be reflected in the profit and loss statement. And any prior period item which is related to the prior period but not recorded earlier due to error, now arises in the current year, then impact of such prior period item should also be disclosed in the profit and loss statement. So and any extraordinary item, loss by fire, loss by theft, etc., should also be disclosed in the P&L. So AS5 discussed that how P&L is prepared. What are the items that are included in profit and loss statement? All items of income and expenses are included in P&L, whether operating, non-operating, cash, non-cash, ordinary, extraordinary, and prior period items as well. And profit and loss account should also reflect the changes, effect of changes in accounting policy and effect of changes in any accounting estimates. Now AS6 is regarding depreciation, which is buzzed into AS10. Earlier for depreciation accounting there was AS6, but now it is merged into AS10. AS7 is regarding construction contract. Construction contract. Suppose I am a contractor. You are a contractee. I am making a building for you. I am doing some contract for you. So I am a contractor. So how revenue is recognized in my books? Accounting. So AS7, accounting standard 7, is applicable in the books of contractor for recognition of revenue. Why there is requirement of AS7? Suppose I am a contractor and I took a contract for you to construct a building. Say it will take 3 years. Suppose students, try to understand this. Suppose a building will take 3 years to complete. Suppose a building will take 3 years to complete. Okay. Now each year costing is rupees 5 lakh, 4 lakh, 3 lakh. Suppose 12 lakh is costing. Estimated cost of completion of building is 12 lakh. Estimated cost of completion of building is 12 lakh, and I being a contractor decides revenue, and total revenue from that building is 20 lakh. So the problem is that the cost is divided into 3 years, but revenue is agreed for the entire period of 3 years. So we have to bifurcate that revenue of 3 years into each year, because profit and loss statement is prepared for each year. We have to calculate the profit and loss. We have to calculate the profit and loss for each 3-year period. So for calculating profit and loss for each 3-year period, we require revenue for each of the 3 years. But in construction contract, the problem is that where revenue is agreed for the entire contract period and cost is incurred periodically year by year. So AS accounting standard 7 prescribed that how revenue should be recognized. And AS7 mentioned the method called percentage completion method. We have to calculate, as per accounting standard 7, we have to calculate the percentage of completion of the contract, and according to the percentage of completion, we will bifurcate the revenue for the 3 years period and accordingly calculate the profit or loss on contract. This is all about AS7. Now students, try to understand that there is no accounting standard 8. AS8 is eliminated and merged into AS26. AS8 is eliminated and merged into AS26. Now, after AS7, we have AS9, Accounting Standard 9. Now, Accounting Standard 9 is regarding revenue recognition. Accounting Standard 9 is regarding revenue recognition. How revenue should be recognized in the books. Whenever you prepare profit and loss account, sales is credited in trading account, other income is credited in profit and loss account. So when income are credited, definitely income will be credited when there is an accrual. When there is then the question arises, when there is accrual. Accrual is always only when, as per AS9, right, try to understand some accounting is related to asset, liability, income or expenses. Whenever there is any dispute regarding any accounting of any item, Institute of Chartered Accountants of India issued the accounting standards. So some accounting standards are on assets, some on liability, some on expenses, some on income. So this AS9 is on income revenue recognition. When revenue will be recognized? It is recognized when it is accrued. When it is treated as accrued? It is treated as accrued when? It is treated as accrued when? When there is no uncertainty as to collection. AS9 prescribes that whenever there is no uncertainty as to ultimate collection of the revenue, collection is not necessary. There is no uncertainty in collection. Suppose I make a sale, credit sale, and my auditor, my financial accountant ask me whether to record whether there is certainty in collection. I will tell him, yes, there is certainty in collection. If there is certainty in collection, then definitely it is treated as accrual, and accrual, it means it is recorded whether cash is not received. Accounting is based on accrual principle, not on receipt payment basis, not on cash basis. So when revenue is recognized as per AS, yes, revenue from construction contract, AS9 is not applicable on all revenue. Yes, revenue from construction contract is recognized as per AS7, but other revenues are recognized as per AS9. And there are some other accounting standard also which deals with revenue recognition. You should know this, like this, AS9 is applicable on the revenue except those revenue on which other standards are applicable. So recognition of revenue from sale of goods, recognition of revenue from sale of services, recognition of revenue from other items, say royalty, interest, dividend, all are revenue for the business. Interest received or receivable, dividend received or receivable, royalty received or receivable, revenue from sale of goods, revenue from rendering of services. AS9 is applicable on all revenues, and AS9 specifically provide that when there is when there is certainty for ultimate collection, there is no uncertainty in collection. As at the time, if you are sure that there is collection certainty, then you can record the revenue as per AS9. Now the AS10 is regarding property, plant and equipment, fixed assets and its depreciation. AS10 is regarding fixed assets and its depreciation. The new AS10. Earlier AS10 is only for fixed asset, AS6 is for depreciation. The new AS10 is combo for both depreciation and fixed assets, and only tangible fixed assets, and only tangible fixed assets. Okay, students. So AS10 deals with how fixed assets are recorded. Fixed assets are recorded at cost, how cost is calculated, what are the initial expenditure, and all the expenditure which are incurred for bringing in the asset ready to use. Till that date, till that time, all the expenditures are treated as capital expenditure and not transferred to P&L. It is added to the cost of asset. So AS10 deals with what is fixed asset, what is the definition of fixed asset, how fixed assets are recorded, or how fixed asset is recorded at cost, how cost is calculated. Fixed asset is acquired, that is called acquired fixed asset. When fixed assets are in construction, we are constructing building, we buy a building, we buy a machinery, it's a acquired fixed asset. But when we construct building for our business as it is called self-constructed assets. So how the acquired fixed assets are recorded, how self-constructed fixed assets are recorded, how the depreciation is charged, and how fixed assets are shown in balance sheet. Yes, fixed assets are shown in balance sheet at cost less depreciation as per AS10. There is another AS also regarding some impairment loss, which is AS28. But AS10 deals with cost less depreciation. And revaluation is also permissible as per AS10. As per accounting standard 10, every year or in a frequent intervals, assets and fixed assets can be revalued, and there may be revaluation profit or revaluation loss. It should be recorded. And if there is a sale of fixed asset, then any profit or loss on sale of fixed asset should be credited or debited to profit and loss account. So AS10 deal with cost of fixed asset, recognition of fixed asset, revaluation of fixed asset, depreciation of fixed asset. There are three methods allowed in AS10: straight line method, written down value method for depreciation, and also production unit method of depreciation. Suppose asset cost rupees 1 lakh. Asset cost rupees 1 lakh. Suppose scrap value is 0 and total production is 20,000 units, maximum production possible. So the depreciation is 5 rupees per unit. This is called production unit method. Depreciation is 5 rupees per unit. And if in the first year only 10,000 units are manufactured, 2,000 units are manufactured, then 2,000 into 5, 10,000 is depreciation. Next year 3,000 units manufactured, 3,000 into 5, 15,000 is depreciation. So AS10 deals with depreciation of fixed assets. AS11, definitely students try to understand this. There are foreign currency transaction in your business. You can buy goods, you can sell goods out of India, out of the country, in another countries. So there is foreign currency involvement. Definitely you have to pay $1. You have to pay $1. $1 today 70 rupees. But when you are going to pay, it will be 72 or 69. There may be profit or loss. You have to receive $1 from America. You sold the goods, you exported the goods. You have to receive the $1 from America, USA. Now, at the time of transaction, the dollar was 70 rupees, but when the dollar actually received, it is 68 or 72. So there is profit or loss. The student, you should remember that, you should note that there is always a fluctuation in foreign currency, and therefore, foreign currency transactions, on foreign currency transaction, there may be profit or loss due to exchange difference, exchange fluctuation. So as per accounting standard 11, any exchange difference, profit or loss, should be transferred to profit and loss account. And also AS11 deals with conversion of trial balance of foreign operation. Suppose I have a business in India and I have a branch in USA, Canada, Australia. So Australian branch will prepare its trial balance accounting in Australian dollar. Canadian branch will prepare its trial balance in Canadian dollar. American branch will prepare its trial balance in American dollar. Suppose I have a branch in Dubai itself, Dubai also. Then Dubai branch will prepare in their trial balance in a local currency, dirham. Suppose I have a branch in Kuwait also. So Kuwait branch will prepare its trial balance in Kuwait currency of Kuwait, that is dinar. So in India, I am preparing my head office main business in India. In India, I am preparing my financial statements in Indian rupees. So if I want to I want to prepare combined financial statement for my main business head office and for all the branches, for US branch, for Canada branch, for Australia branch, for Dubai branch, for Kuwait branch. So all the trial balance in foreign currency should be converted into Indian currency and then will be merged in Indian financial statement. So there are conversion rules prescribed in AS 11. So student, note that accounting standard 11 deals with profit or loss on exchange transaction and also deals with how foreign currency operations, how foreign foreign operations, how foreign operations, suppose foreign branch, foreign subsidiary, foreign associate, foreign joint venture, how foreign operations financial statement will be converted into Indian currency, our home currency. So this is about AS 11. Now AS 12 is regarding students government grant. Accounting standard 11 is 12 is regarding government grant. Government grant, it is assisted by government. For example, there is a company, say A Limited is a company. Now government is its promoter or not a promoter, but government is assisting that company by giving some grant. Grant may be monetary, maybe non-monetary. Non-monetary means government gives you machinery, land, building, plant, other than cash. Other than cash grant, other than cash grant is a monetary grant. Other than cash grant is a monetary grant. Non-monetary grant, very sorry. Other than cash grant is a non-monetary grant. But if government gives you any company, any corporate, any business, any entity, any enterprise, suppose government gives rupees 20 lakhs, rupees 5 lakh, rupees 12 lakh in cash through bank, definitely. It is called monetary grant. So there are monetary grant, there are non-monetary grant. And as per AS12, accounting for monetary and AS12 suggests accounting for monetary as well as non-monetary grant. Accounting for monetary as well as non-monetary grant. Okay. Now next thing is AS12. After AS12, AS13. AS13 is accounting for investment. There are two types of investment as per AS13: current investment and long-term investment. Current investment and long-term investment. What are investments? Investments are assets. Investments are assets. Why it is in the business? It is for earning income. If it is for use, it is fixed asset. If it is for sale, it is stock. Suppose I bought a machinery for sale. Machinery is my stock. Suppose I bought a machinery for use. It is a fixed asset. Suppose I bought machinery just to earn income, just to give it on rent, then it is a investment. So any asset which is held in business for earning income may be by way of interest, maybe by way of dividend, maybe by way of rental, and maybe by way of capital increase. No income, no rental, no interest. But my 10 lakh building, after 2 years, it is 15 lakh. I got capital appreciated. That is income. So investment, as per AS13, AS13 deals with accounting for investment, and as per AS13, investments are of two types: current investment and long-term investment. And long-term investments are those which are not current investment. It's a residuary definition. So we should learn the definition of current asset. What current investment? What are current investment? Current investments are those investments which are readily realizable. Which are readily realizable into cash. Not necessarily sold, but it is readily realizable. It is for the intention of purchase is not to hold, it is for sale. Which are being bought. Not sale is not necessary. You don't sell it for 3 years, but your intention is for sale and they are sellable. Then it's called current investment. So in balance sheet, current investment and long-term investment are separately disclosed. And how these investments are recorded in books, how these investments are carried in the balance sheet, this is given in AS12. And any profit or loss on investment, any profit or loss on sale of investment or investment fluctuation, value fluctuation, it should be credited or debited to profit and loss account as per AS13. And student, there are various transactions regarding amalgamation, absorption. X Limited purchased Y Limited, Y Limited purchased Z Limited, Z Limited acquired the business of P Limited, X and X Limited, Y Limited combined together to form a new company, Z Limited. Any amalgamation, absorption, external reconstruction on the accounting of such accounting for such transactions, accounting for such transaction, accounting standard 14 is applicable. Accounting standard 14 is applicable on accounting for amalgamation, absorption transactions. And earlier in my earlier class, I told you that whenever there is business purchase, all assets are debited in the books of purchasing company. Liabilities are credited. Suppose 10 lakh asset debit 10 lakh, liability is 2 lakh, liability credited 2 lakh. Difference is net asset called 8 lakh. Now we will pay the consideration, suppose 12 lakh. So instead of paying 8 lakh, we are paying 12 lakh. It means 4 lakh extra. It is goodwill. So whenever any business is acquired, an extra payment is made, such extra payment is debited to goodwill account in the books of purchasing company. And if any short payment is made, it should be credited to capital reserve as per AS 14. And as per AS 14, there are two types of amalgamation absorption. Yes, they are in the nature of merger and in the nature of purchase. You don't go into the depth of that. If it is a merger, any profit or loss is adjusted in general reserve or P&L. But if it is a case of normal amalgamation, not in the nature of merger, then any profit or loss should be profit. It's credited to capital reserve. Loss, extra payment is debited to goodwill. So this is all about accounting standard 14. So students, we have theoretically discussed AS1 to AS14 in the today's class. In the next class, student listen this. In the next class, I will explain you in the last part of the class all the remaining accounting standard, and definitely in the next class we're going to learn the concept of consolidation also. In the next class, consolidated financial statement, what are the basic concept of consolidation, what are the basic calculation of consolidation, how different items are deal in consolidation, we will discuss in the next class. So our next class will cover consolidation lecture, remaining accounting standard lecture, and the starting of your second part, management accounting, that is overview of cost, etc. Yeah, in that management accounting portion, we will study marginal costing, decision making tools, budgets, etc. And in the last, this is about third class, the third lecture. Then in fourth lecture, management accounting will be continued, and in the fifth lecture, in the last class, I will summarize the total subject again. Yes, definitely. So okay, students, so we will meet in the next class. All the best, students, for we'll meet in next class. And in the next class, write down this. We will start consolidation. We will learn all the concept of consolidated financial statement, a very important topic, and the remaining accounting standards and the other theory portions. Okay. Bye bye.